Hi, welcome to Listen2Riches. Today, I am going to share with you the summary of the book The Intelligent Investor by Benjamin Graham. Benjamin Graham is widely known as the father of value investing. He is the author of two important books on modern investing, Security Analysis in year 1934 and The Intelligent Investor in year 1949. Before diving into a career on Wall Street, Graham studied at Columbia University. Later, he established the Graham-Newman Partnership where he brought on board a young Warren Buffett. Buffett learned a lot from Graham's strategies, and interestingly, he even wrote the introduction for one of Graham's books. Graham's way of investing was always rooted in understanding how investors think, keeping debt to a minimum, the concept of buying and holding on to investments, having a focused approach to diversification, and only purchasing stocks when they were priced with a good margin of safety. The Intelligent Investor is a guidebook crafted to assist individuals in navigating the stock market while keeping their financial risks in check. This book emphasizes strategies that span over longer periods and prioritize caution against risks. Benjamin Graham, the author, directs attention towards making well-researched investments rather than relying on speculative predictions. Money is a topic we're all familiar with. Yet, it's not always something we fully understand. Sure, we might grasp the importance of handling money smartly, setting budgets, saving up, and avoiding debt. But translating these notions into actionable steps can sometimes be a puzzle. Especially when it seems like the financial game is rigged against us, a future many folks are bracing for. But don't let those challenges cast a shadow of financial gloom over your days to come. Throughout this overview, we're going to unravel some blunt truths about managing money and unveil the path to financial triumph. In the pages ahead, we'll explore the author's insights into personal finance, revealing the secret sauce for effective budgeting, clever saving, and making savvy investments. So, let's take the plunge. Your financial horizon is bound to shine brighter as we embark on this journey together. We will separate the summary into three parts. The first part, why you should invest in the stock market. Second part, which type of investor we should become. And the third part, don't listen to Mr. Market. Without further delay, let us delve into the first part, why you should invest in the stock market. Books on achieving financial success are just as sought after as any other genre in the realm of self-help. They offer a variety of strategies for quickly amassing wealth. Some highlight the specific journeys of individuals like Warren Buffett or Donald Trump, who struck it rich through investing. While these stories can provide valuable investment insights, they're often tailored to individual circumstances and the state of the stock market during their time. If replicating their success were a breeze, everyone would be the next Buffett or Trump, and their stories wouldn't hold their allure. However, in the scope of this book, we're ditching the notion of copying someone else's success blueprint. Our focus shifts to robust financial science, teaching you how to leverage stock market statistics in your favor. The author's starting point is that making money from investments demands intelligence. The most crucial lesson for any savvy investor is mastering risk management. We're all aware of the stock market's volatility. Change is its constant companion. To thrive here, you must be adept at adapting and making informed choices for your investments. The common pitfall is believing that swift action is essential to profit from the market's fluctuations. It's understandable given the market's abrupt dives. The urge to stay constantly vigilant is strong. This mindset leads to frenzied buying and trading in the hopes of outsmarting the market and reaping substantial gains. For a long time, this approach has been the go-to for stock market engagement. Yet, astute investors recognize its limitations. Rather than rushing, wise investors meticulously analyze a stock's potential. If their assessment indicates that a stock's price is lower than its true value, they take the plunge. Buying when a stock is undervalued means it has growth potential in relation to the company's actual worth. In the early stages, a company's stock might not attract much attention. But if you foresee it becoming the next big thing, with its stock value poised to soar, getting in early is prudent. Think about investing in Facebook before it became the global sensation it is today. Back when it was just a small social media platform originating in a college dorm. At the outset, Facebook might not have appeared monumental to potential investors. However, those who invested in it during its infancy reaped the rewards of its phenomenal growth. The same opportunity might await you with an undervalued business. While this entails playing the long game, astute investors know it's incredibly lucrative. The intelligent investor isn't preoccupied with when their stocks will turn profitable. They issue hasty decisions or fixating on immediate value surges. Instead, they deeply understand their stocks in the market and exercise patience. They have faith that the market will follow its natural course, as they anticipate, and they wait for the harvest. In essence, this chapter imparts a critical lesson: assess your stocks for their pricing and potential, and only invest when confident your assessment will bear fruit. This route may be gradual and perhaps mundane, yet it promises substantial gains. Frankly, would you prefer fleeting excitement or $1 million in your pocket? Now let us continue to the second part: which type of investor we should become? The author draws on their own experiences to distinguish between two key types of investors: the defensive investor and the enterprising investor. The defensive investor leans towards safeguarding and managing risks above all else, while the enterprising investor is open to taking bolder risks. Both approaches have their merits and can bring profits, yet the tortoise-like steadiness often proves to be the winner. The defensive investor embraces this concept by diversifying their investment portfolio. If the term is new to you, financial analyst Troy Siegel offers a clear and simple explanation. Essentially, Siegel states that diversification is a strategy to manage risks by including a wide range of investments in a portfolio. This mix involves different kinds of assets and investment methods to limit exposure to a single risk or asset. The idea behind this approach is that a portfolio with diverse assets will typically yield higher long-term gains and decrease the risk linked to any single holding or investment. Diversification aims to balance out unpredictable risks in a portfolio, so the positive performance of some investments counteracts the negative performance of others. The benefits of diversification work best when the assets in the portfolio don't move in perfect harmony. In other words, they react differently, sometimes in opposing ways, to market influences. Research and mathematical models reveal that having a well-diversified portfolio with around 25 to 30 stocks provides the most effective risk reduction. Adding more securities brings more diversification benefits, but at a slower rate. In practical terms, this implies that a defensive investor should consider a mix of common stocks and government bonds in their investment choices. Lastly, the author recommends that a defensive investor should aim to invest in at least 10 different companies, preferably those with a solid reputation and a long history of success. This adds extra stability, reduces risks, and maximizes potential rewards. On the other hand, enterprising investors begin similarly and then venture down their own, somewhat riskier, path. Enterprising investors are more inclined to take chances on emerging companies and invest in a broader range of common stocks. As mentioned earlier, both investor types are equally valid and their strategies can yield equivalent profits. Ultimately, the determining factor is identifying the investment strategy that best resonates with your goals and personality. After understand which type of investor we should become, let us move into the final part: don't listen to Mr. Market. This chapter stands out as particularly insightful in this book, as it prompts us to reshape how we perceive the stock market. The author notes that investors often elevate the stock market to the status of an all-knowing deity. They enthusiastically invest their time, money, and happiness in this pursuit, even if it ends poorly. However, the author emphasizes that adopting a different mindset is crucial for becoming an intelligent investor. Instead of viewing the stock market as a grand and glorious force, consider it as a person named Mr. Market. This perspective helps demystify things because, in reality, Mr. Market isn't exactly pleasant. He's moody, self-centered, and indecisive. He dangles enticing promises when he's in a good mood, only to abandon them when his mood sours. In fact, if Mr. Market were an actual person, he'd probably have no friends. So, far from being charismatic and influential, you'd likely distance yourself from him. The author suggests that this is the right approach. An intelligent investor regards Mr. Market as a stingy, grumpy, wealthy relative who might leave you an inheritance. It's wise to treat him with respect, but you wouldn't rely heavily on his words or get too close. By adopting this viewpoint, you can remain composed. While others panic and buy or sell stocks based on Mr. Market's whims, you can remain composed and consult the data. For instance, let's return to the analogy of Facebook. Imagine you spot potential in a company that others haven't recognized yet. Initially, its stock might be low since Mr. Market doesn't see its potential. But if your analysis indicates that this company could be the next Facebook, you'll reap rewards when your stocks become lucrative, while others miss out. However, there's a flip side. Suppose you've invested in a luxury car company like Maserati. They've just released a new model causing a global frenzy. Mr. Market, drawn by the excitement, hails Maserati stock as the next big thing. But what if the new car disappoints? If the new model flops, Mr. Market's mood will sour again, dragging others' moods and finances with him. His shining promises will vanish, leaving you with more losses than you anticipated. This example illustrates why Mr. Market and the crowd's opinions are unreliable. Both are fickle and unpredictable, leading to disappointment if you rely on them. That's why it's essential to be the wise investor who scrutinizes every investment. Be the one who assesses a company's financial history before committing your money. Evaluate the long-term potential and avoid being swayed by fleeting trends. Don't be deceived by short-term profits either. A seemingly successful company might have a shaky foundation or questionable business principles that can cost you later. In essence, don't let Mr. Market fool you, and don't overly trust the crowd's opinions. Did you catch that? A stock pun? Okay, maybe a tad cheesy. To sum up, the vital lesson from this chapter is to think independently and maintain a realistic perspective on the stock market. In conclusion, the world is filled with a wealth of financial advice for those eager to step into investing. Amidst the clamor, everyone is striving to rise above the noise, each proclaiming their advice as the ultimate truth. However, not all these sources can be trusted. Yet, the author's guidance has weathered the storms of time. These are the strategies that carried him through the daunting Wall Street crash of 1929. They've been handed down to countless generations of prosperous investors who came afterward. And here you are, in 2021, able to lean on these very same strategies. Despite the potential profound impact in practical use, this advice isn't intricate. To become an intelligent investor, you simply need to cultivate independent thinking. Remember that Mr. Market is no divine oracle. He's a rather disagreeable and fickle individual. His words aren't gospel, and the fleeting trends of investments are just as unreliable. So, don't let your common sense fade away in the midst of the crowd's noise. Lastly, bear in mind that while slow and steady investing might seem unexciting, it's consistently the most profitable route because it's thoughtfully planned out. Thank you for joining me for this review and summary of the book. If you want to listen to more audiobooks, please do not forget to click on like and subscribe to my channel. And if you have other books you'd like to talk about, feel free to tell me in the comments below. See you in my next audiobook.